So I think it's important to emphasize that the banking system broadly is very robust, strong deposit base, strong regulatory framework, strong business models. That's particularly the case in Canada. Where the problems have arisen have been in idiosyncratic pockets of the banking system. Regional banks in the US, for instance, where there have been a confluence of some mismanagement, a more volatile deposit base, and also some shortcomings on regulation, but of course have led to capital flight or deposit flight out of several institutions, which have led to a number of policy initiatives by central banks, the federal government in the US, and then in Europe, in Switzerland, the arranged takeover of Credit Suisse by UBS Bank. Market expectations around central bank policy outlook have swung wildly over the past 2 weeks. Ahead of the financial volatility, markets had been conditioned by the Federal Reserve to expect more interest rate increases. With the onset of the volatility, those expectations shifted to expect no more rate increases and actually a quick pivot to rate cuts. We think the truth lies somewhere in the middle. Markets have been too aggressive in pricing a pivot towards rate cuts. At the same time, we do expect growth to slow. We are looking for a mild recession to occur in the US, in Canada, in Europe over the next 12 months. And that will slow inflation. The inflation rate in the US and other economies will moderate over time. The question is, how quickly? That suggests to us that central banks continue to focus on the importance of cooling inflation, reducing inflation back towards their target, but also being very cognizant that their words have great import for confidence in the financial system. In terms of specific opportunities, one that is particularly attractive right now is fixed income. Fixed income has had a difficult couple of years. When interest rates rise, bond prices fall. So that has been quite painful for investors in bonds. That situation has changed significantly with interest rates and bond yields at much more attractive levels. This means that bonds can get back to playing their traditional role within a balanced portfolio as a counterweight to equities during periods of market volatility, but also as a standalone, attractive source of return. So what does this mean for investor portfolios? In normal market conditions, trying to time market participation is difficult. During periods of high volatility, timing markets is almost impossible. We think it really important to focus on long-term fundamentals. Which asset classes have the most attractive long-term expected returns? So again, a focus on long-term investment goals and objectives is particularly important during periods of volatility, such as we're experiencing right now.